Good day, everyone. Today we are tackling one of the most requested topics in our inbox, the deposit hurdle. You know the drill. You got a good job, your income is solid, you've cut back on the smashed AVU. Sorry to use the cliche, but that 20% deposit is moving target. Australian government has 5% deposit scheme at the moment, but some people still have difficulties to achieve them. Every time you save 10 grand, property prices jump 20. It feels like you're running on a treadmill, right? Well, today we're going to break down the specific strategy that bridges that gap. We're talking about guarantor loans. I've got a document in front of me that lays out the nuts and bolts, but we're going to go deeper. We're going to look at the psychology, the hidden risks, the massive benefits, and the alternatives. If you're thinking of asking your parents for help, or if you're a parent wondering if you should put your hand up, this episode is mandatory listening. Segment 1. The reality check and the definition. Let's start with the basics. What exactly is a guarantor loan? In the simplest terms, a guarantor loan is a way to hack the deposit system. Usually, when you go to a bank, they want two things. They want to know you can pay the mortgage, that's your income, and they want security, that's your deposit. Now, according to the breakdown we're looking at today, a guarantor loan allows a family member to step in and use the equity in their own property to secure your loan. I want to be crystal clear on this. In most cases, your parents or whoever the guarantor is are not paying your mortgage. They aren't transferring cash into your account every month. You are still the primary borrower. You are responsible for the principal, the interest, and the fees. So what are they doing? They are essentially acting as a backup generator. They are offering a portion of their home's value as extra collateral. If everything goes well, the bank never knocks on their door. But, and this is the big but, if you default and the house is sold for less than what is owed, the bank comes for that guarantor security to make up the difference. It's a serious legal commitment. It's not just a signature on a piece of paper. It's a lien on their property. Segment 2. The cast of characters. So, who can actually do this for you? Can you get your rich mate from uni to sign off on it? Generally, no. Australian lending standards are pretty strict here. The lenders want to see a close relationship. The document we have specifies that this is predominantly the domain of immediate family. We're talking parents or parents-in-law. That is the gold standard. However, the market is shifting slightly. Some lenders, not all, but some, are opening this up to siblings, grandparents, and in very specific, rare cases, close friends. But be warned, the further you get from mom and dad, the fewer lenders you'll have to choose from, and the interest rates might not be as pretty. Here is the checklist for a potential guarantor. If you're thinking of asking someone, they need to tick 3 boxes. Equity. They need to own a property or have paid off most of it. Credit. They need a squeaky clean credit file. Stability. They need a stable income or a very strong asset position. If your parents are retired, it doesn't mean they can't help, but the bank will look very closely at their assets to ensure they aren't risking their retirement survival. Segment 3. The why. The massive benefits. Okay, let's talk about the good stuff. Why would you do this? Why take the risk? There are 2 major financial incentives here. Number 1 is speed. Saving a 20% deposit on an $800,000 home is $160,000. Plus stamp duty. That could take a decade. With a guarantor, you can technically borrow up to 100% of the property value, and sometimes even more to cover the costs like stamp duty and legal fees. It literally fast-forwards your entry into the market by years. Number 2 is the LMI Killer. This is the big one. LMI stands for Lender's Mortgage Insurance. Usually, if you have less than a 20% deposit, the bank forces you to pay this insurance. Now, here is the secret that banks don't always scream about. LMI protects them, not you. If you default, the insurance pays the bank, and then the insurer comes after you for the money. It's a sunk cost. On a standard first home, LMI can easily be $15,000 to $30,000. By using a guarantor to top up your security to that 20% mark, you avoid LMI entirely. That is $20,000 you don't have to borrow, and you don't have to pay interest on for the next 30 years. That is a massive wealth hack. Segment 4. The mechanics of risk. But we have to be real. This is a podcast about financial truth, not just hype. The risks here are significant, and they fall disproportionately on the guarantor. The source material puts it bluntly. The benefits are for the borrower, but the risks are mostly for the guarantor. Let's scenario plan this. You buy the house. You lose your job. You can't pay the mortgage. The bank sells your house. Because the market dipped, the house sells for less than the mortgage balance. The bank doesn't just write that loss off. They go to your parents. They say, "Hey, remember that guarantee? We need that $50,000 difference now." If your parents don't have the cash, they might be forced to sell their own home to cover your debt. That is the nightmare scenario. And it's not just about losing the house. It's about credit reporting. If you miss payments, it doesn't just trash your credit score. It can mark your guarantor's file too. It's about retirement. If their assets are tied up in your loan, they might not be able to downsize or access their equity when they need it for aged care or travel. It's about borrowing capacity. If your parents want to buy an investment property or renovate their kitchen, the bank might say no because they're technically liable for your huge debt. And let's not forget the emotional toll. The document mentions this, and it's crucial: relationship strain. Nothing ruins a Christmas lunch faster than a foreclosure notice. Money changes family dynamics. If you're the borrower, you need to understand that every time you spend money on a holiday or a new car, the guarantor is watching and thinking, "Is that my house security you're spending?" Segment 5. The guardrails, limited guarantee. Now, before I scare everyone off, there's a way to mitigate this. It's called a limited guarantee. In the old days, guarantees were often unlimited, meaning the guarantor was on the hook for the entire loan. Today, smart brokers structure this differently. You can choose to have the guarantor secure only a portion of the loan. For example, if you buy a $500,000 place, you might borrow $400,000 against the house itself, which is 80%, and secure the remaining $100,000 against your parents' house. Once you pay off that $100,000 chunk, or once your property value goes up enough to cover it, you can release the guarantor. That is the strategy. Get in, pay down aggressively, and get them out. You should enter this arrangement with an exit strategy already in writing. Segment 6. Borrowing power and serviceability. I want to touch on a misconception here. People think, "Oh, I have a guarantor, so the bank will lend me whatever I want." Wrong. The document emphasizes this. The bank still looks at your ability to repay. They will comb through your income, your living expenses, your Uber Eats history, and your credit cards. A guarantor helps with the security, which means the deposit, not the serviceability, which means the monthly repayment. If you earn $50,000 a year, you aren't getting a $1 million loan just because your dad is a millionaire. You still need to prove you have wriggle room to afford the loan if interest rates rise. In fact, recent data from the Reserve Bank of Australia suggests that first home buyers who get family help are actually more likely to face cash flow stress later on. Why? Because they might have bypassed the discipline of saving the huge deposit, so they aren't used to the frugal lifestyle required to service a big mortgage. Segment 7. The alternatives. If you've listened to this far and you're thinking, "No way, too risky, I love my parents too much to do that to them," that is a fair call. So what are your other options? The document outlines 3 main alternatives that families use to help out. Option 1. The cash gift or the bank of mom and dad light. Your family gives you a lump sum to boost your deposit. Here is the catch. The bank needs to know if this is a gift or a loan. If it's a gift, you usually need a statutory declaration signed by your parents saying, "This money is non-refundable." If it's a loan that you have to pay back to them, the bank counts that as a debt. That lowers your borrowing power. You can't trick the bank here. They will see the transactions. Option 2. The cosigner or joint borrower. This is different from a guarantor. This is where your parents actually go on the title with you. They own part of the house, and they are fully liable for the loan alongside you. This helps with serviceability because their income is included. However, this gets messy. It can impact your first home owner grant eligibility. It has capital gains tax implications for your parents because it's technically an investment property for them. It's a legal minefield, so get a lawyer involved. Option 3. The boomerang strategy. This is the low-tech solution. You move back home. You reduce your rent to 0 or very low board, and you aggressively save that cash. It's not glamorous. It might cramp your style, but 12 months of living rent-free can sometimes equal the same financial benefit as a guarantor loan, without the legal risk to your parents' home. Conclusion, the final verdict. So what does that leave us? A guarantor loan is a power tool. Used correctly, it builds your future. Used recklessly, it can dismantle your family's wealth. If you're going to go down this road, here is my 3-step advice. Transparency. Have the awkward conversation. Discuss the what-ifs. What if you lose your job? What if interest rates hit 8%? The exit plan. Don't just set it up. Plan the end date. Aim to refinance and release the guarantee within 3 to 5 years. Professional advice. Do not DIY this. The guarantor needs their own independent legal advice. In fact, most banks require the guarantor to see a separate lawyer to ensure they haven't been coerced. The property market is tough, but you have options. Whether it's a guarantor, a cash gift, or just grinding out the savings while living in your childhood bedroom, the key is to understand the rules of the game. That's it for this deep dive. If you found this helpful, share it with your folks. Thanks for listening, and catch you next time.